The billionaire investor Warren Buffett is warning about a major storm that is about to hit the market. A great recession worth $1 trillion is about to strike the United States economy. All indicators expect a crisis worse than 2008, with devastating consequences for the economy. Listen.
But it all has consequences, and I think we are starting to see the consequences of.
Essentially, there are many signs that Warren may be fearing a recession soon. The amount of cash held by Berkshire has grown excessively, and it is clear, based on indicators like the Buffett indicator, that stocks are, in fact, severely overvalued. By almost any existing measure, stocks are severely overvalued, and one doesn't need to look only at the Buffett indicator to see this. For example, the 10-2-year yield, an indicator that has predicted almost every recession in the last 50 years, has now been inverted for over 630 days, surpassing the record set in 1978. When the 10-2-year yield curve inverts, it is a classic sign that a recession may be on the way. And based on data such as the 10-2-year yield curve, one could argue that we have some concerning information suggesting that we could be in trouble soon. Essentially, what many experts believe is that Warren Buffett is waiting for a recession. And although he hesitates to admit it, it's quite clear that he expects headwinds. Now, listen to the next clip from Warren Buffett.
It isn't like I'm got a hunger strike or something like that going on. It's just that things aren't attractive, and there's certain ways that can change, and we'll see whether they do.
Reading between the lines, we all know what this means. By almost any existing measure, stocks are severely overvalued. Looking at the 10 and 2 years yield, it has now been inverted for more than 630 days, surpassing the record set at 1978. When the 10-2-year yield curve inverts, it is a classic sign that a recession may be on the way. This happens when short-term bonds pay more than long-term ones. It's like a warning sign that investors expect the economy to face difficulties in the short term, so they want higher returns quickly. On the other hand, they believe that things will improve in the long term, so they are willing to accept lower returns on long-term investments. Now, if you check the 10-2-year chart, you'll notice that it is still below zero, which means it is still inverted. Historically, this is a negative sign. However, it is not until this line rises back above zero and stops being inverted that we usually see a recession. Considering that we have just broken the record for the longest time in inversion, it is reasonable to think that a recession may come sooner rather than later. This is just the beginning of the consequences that Buffett predicts for this recession. The real impact is expected to start in just a few months. Listen.
You're sitting on $168 billion of cash, which you told us today is now more than $182 billion. His questions are, one, what is Buffett waiting for? And two, why not at least deploy some of it?
Well, I think that's pretty easy to answer. I don't think anybody sitting at this table has any idea of how to use it effectively, and therefore we don't use it, and we don't use it now at 5.4%, but we wouldn't use it if it was at 1%. Don't tell the Federal Reserve that, but
You can naturally infer that when an investor hesitates to use their cash reserves, they perceive the market as lacking valuable opportunities. With Berkshire Hathaway's cash reserve growing to $189 billion, many speculate whether Warren Buffett sees the market as a whole as an overinflated bubble. With 500 companies listed on the S&P, the inability to identify enough suitable candidates raises suspicions. If Warren's not after yield and doesn't really see a good way to spend the money, the natural assumption must be that he believes the current market is very overvalued. And of course, if it is overvalued, there must be a downturn to become undervalued. In 2001, Warren Buffett introduced the Buffett indicator, your own indicator to assess the overall assessment of the United States stock markets. This metric compares the gross domestic product of the United States with the total market capitalization of publicly traded companies in the United States. Essentially, it compares the nation's economic output with the collective value of its publicly traded companies. When one element deviates significantly from the other, this is clearly shown on the chart. Buffett called it probably the best single indicator of where valuations stand at any given time. Currently, the Buffett indicator is at 199%. Signaling that United States markets are significantly overvalued, nearly 2 standard deviations above historical norms. Historically, whenever this ratio has risen to such heights, the market has seen significant declines. Unlike others in the financial world, Warren Buffett and Berkshire Hathaway do not try to predict recessions. They openly admit that they have no idea when they will occur. However, we can distill their approach into a simple theory. They do an excellent job of recognizing when things are overvalued. Eventually, market forces correct these imbalances, leading to opportunities. Warren understands that, while he may not know when or where these corrections will happen, the current situation is anomalous and will likely change quickly over time. While Warren is the most reserved about his bearish sentiments, many Berkshire experts and investors can read between the lines of his statements and understand when he has a bearish view of the market. And one of those times is now. According to Bill Smead, Chief Investment Officer of Smead Capital Management, this is the most bearish view Warren has ever had. Listen to this clip from the CNBC interview where he provides his analysis.
So let's talk about their big cash pile, $180-some billion, heading to $200 billion. What should they do with it? There is some discussion. Would you, as a shareholder, like to see them pay a dividend? Or would you like to see them make a big acquisition? Or would you like to see them buy back shares?
We have no interest in the dividend. It's fine to have them buy back shares, but you always have to think about Berkshire Hathaway, do as I do, not as I say. Because Warren Buffett is a super nice guy, and he has absolutely no interest in offending people. But if you look at what he's doing, he is as bearish as he ever gets. I read right between the lines, right from the beginning at the meeting on Saturday. I was there sitting in the audience, and I thought, okay, huge cash position, trimmed his Apple position. He's nibbling on something below the surface they haven't announced yet. But basically, he is waiting until the next 40% decline in the stock market to apply massive amounts of capital at bargain prices in things that are large enough to be meaningful to this company at the size it is now.
So you just used the phrase, this is as bearish, I believe you said, as I have ever seen him. Is that really the right characterization, or is it rather that he thinks the market is too highly priced for him to go in a big way and put fresh capital to work? In other words, is it so much a bearish call as it is a rejection of the idea that this is an opportunistic time to invest?
Tyler, you have asked a great question. So I'm going to answer this in kind of an odd way. In 1969, he pivoted from being primarily a quantitative Ben Graham value guy to being more of a Charlie Munger qualitative guy, right? Get a reasonable price on a great company. And he said back in 67, 68, 69 that the quantitative ideas that he used to like to buy were combed and recombed. That was his letter to partners. And this last year, he said that the kind of things that we would like to do have been endlessly picked over. So that is code for we think the market's expensive. We're not in any hurry. We're going to wait. And remember, he's talked constantly for 10 to 15 years that the bigger Berkshire gets, the more it limits their opportunities. Right. So really, to have very large opportunities for large deployments of that $200 billion, you've got to have the entire market get into very difficult circumstances.